Very good morning, friends. I hope you're all doing well. And most importantly, I hope you've done your revision in terms of what we did in the previous class at least. So just to remind you, we are working on the consolidated financial statements. We've already done our inputs on a consolidated balance sheet. Now the focus today is on the consolidated income statement and also talking about the third block, which is the changes in the ownership interest. I divided my entire discussions with reference to Index 110 in terms of three parts. One is we understood the scope of the standard and we understood the assessment of control. That was block one. Then we went to the block number two, which is on the accounting procedures for consolidation. How do you make a consolidated balance sheet and how do you make a consolidated income statement? So we're going to focus on the income statement as a part of the block number two. And then our focus will come to the other aspect, which is changes in the ownership interest of an entity. There has been a further acquisition of shares or there has been a disposal of shares. How do we tackle the gain or loss on disposal of the shares, or how do we tackle the step acquisition, to be very precise? Okay, so I think let's begin a journey with the concept of an income statement. Now, before I come to the aspect of consolidated income statement, let me also map in your mind that we did a total of 5 adjustments. I'm not considering the dividend adjustments as a part of my list. So we did a total of 5 adjustments. To recall those 5 adjustments, one was intercompany owings, one was the stock reserve, one is the fair value adjustments, one is the goodwill impairment, and there was omission where we made an extract balance sheet. So we're going to keep a focus very clear that all these 5 adjustments could also crop up in the income statement as well. So as we're going to do questions, we will also consider that how do we tackle these 5 adjustments in a consolidated income statement. To begin with, I'm just going to discuss one adjustment right now, and that is the adjustment of stock reserve, or what we call the unrealized profits. But don't worry, we'll consider all the 5 adjustments and see what is the impact of all these adjustments on the income statement. In fact, I had also given you a chain of thought, and I said, you need to be conceptually clear regarding these 5 adjustments in terms of Index 110 as well as Index 28. You should know how to tackle this in the consolidated balance sheet and the income statement for the subsidiary, for the associate. So once you know the accounting treatment and all the 4 permutation combinations, trust me, you're going to get a good hold in terms of consolidated financial statements. So I think on that note, let's begin the journey on consolidated income statement. So my focus right now is on the consolidated, you can call it as a profit and loss, or let's call it as an income statement. So I'm going to first of all give you 3 important focus points. When you make a consolidated income statement, I've got a total of 3 focus points coming to my mind. Well, the first thing is when you make a consolidated balance sheet, it is as on a particular date. But when you make a consolidated income statement, it is covering a period of 12 months. It is for the year ended. So the very first focus in the question is to look at the date of acquisition. I'll tell you why. So I'm giving you the focus point number 1. When you make a consolidated income statement, there is going to be a very first focus point which you need to consider. And what is the focus point? You're going to first of all look at the date of acquisition. So I would say there are 2 categories of question. Either the date of acquisition is before beginning of current year, or we can say it is in between the current year. It is in between the current year. So you need to first of all see very carefully that what is the date of acquisition? Is it before the beginning of the current year, or is it somewhere in between the current year itself? Now, you would say, why are you focusing on this aspect? If your date of acquisition is before the beginning of the current year, the entire current year is post-acquisition. When you make a consolidated income statement, you need to consolidate the post-acquisition profits. Because if you remember, even in the consolidated balance sheet, you consider the profits of the parent and you add the share in the post-acquisition profits. So what is important is when you do a consolidated income statement, your very first focus needs to be on the acquisition date. So when you say that the acquisition date is before the beginning of the current year, we can outrightly say that the current year is 100% post-acquisition in nature. The current year profits are 100% post-acquisition, so you can aggregate 12 months income, you can aggregate 12 months expense. Just like a balance sheet, you aggregate the assets and liability. In the income statement, we aggregate the income and expense. So once you know that the date of acquisition is something which is before the current year, you can aggregate 12 months income and 12 months expense. So when I say 100% post-acquisition, then we can aggregate all the 12 months income and expense. But when you say that it is in between the current year, then we can say that the current year is partly post-acquisition. Then it is partly post-acquisition in nature. Then I will not be able to consolidate all the 12 months income and expense. Let's for convenience consider the date of acquisition is middle of the year. If the date of acquisition is the middle of the year, then you would consolidate only the remaining 6 months from the acquisition date till the balance sheet date or till the year end. So in this particular case, the consolidation will be only for post-acquisition period. The consolidation will be only for the post-acquisition period in this particular case. So if it's in the middle of the year, then I would consider middle of the year till the year end. I hope I stand very clear on my focus one. So when you're going to start a question, the first thing is to notice the acquisition date. So that I'm very clear that am I supposed to aggregate all the 12 months income and expense or only a certain number of months? Right, friends, I hope I stand clear on my thoughts. This is focus number one. Great. Now let's go to the focus number two. Now let me come to the second issue, that is the focus number two. So I'll give you 3 focus points. So now I'm giving you the focus number 2. What am I supposed to do in the consolidated income statement? In fact, the focus number 2, which I am discussing, is one of the adjustments, and that is unrealized profits, or you can say stock reserve. So it's not that I'm not discussing the other adjustments, but for the time being, this is one of the most common kind of adjustments which you can confront. So in terms of focus number 2, we're looking at the elimination of the stock reserve, or you can say the unrealized profits. The elimination of stock reserves, or you can say the elimination of the unrealized profits on account of unsold goods. Now, the first thing you need to keep in mind is that for the income statement per se, as of now, it does not make a difference whether it is downstream or it is upstream in nature. Hear this carefully. So when you're looking at a consolidated income statement, it does not make a difference at the stage whether it is a downstream or it is an upstream transaction. Irrespective, the treatment is common for the time being. So let's consider some data, some figures to get this clear. So let's say I'm making a consolidated income statement. And let's consider a few columns, one for the holding company, one for the subsidiary company, one for the adjustments, and one for the total. So we're going to make a columnar income statement in this case. So we're going to consider one holding company column, subsidiary company column, one column for the adjustments, and then there is total, that is consolidated income statement. Now, let's consider, we've considered the revenue, that is the sales. So let's say the holding company has got a sale of 200 lakhs. Let's say the subsidy has got a sale of 100 lakhs. And let's give you a data that the holding company made a sale to the subsidy company for, let's say, goods which are worth 20 lakhs. And it is sold at the sale value is, let's say, 25 lakhs. And let's consider that all these goods are unsold at the end of the year. So we can very clearly see that there is a profit of 5 lakhs on the deal. The parent company made a sale of goods costing 20 at 25 lakh. So there is a profit on sale which is 5 lakh. Now, what do you need to do? Watch this carefully. So first I've taken a revenue. Let me also consider the cost of sale. Just taking some arbitrary figures. Let's say this is to the extent of 80 lakhs. And let's say this is to the extent of, let's say, 45 lakhs. Now, at the first instance, what am I supposed to do? I will eliminate the intercompany sale and purchase from both the revenue and the cost of sale. Mind the words carefully. I will eliminate the intercompany sale and purchase from both revenue and the cost of sale. If the parent company made a sale of 25 lakhs, this is including this 25 lakhs. And if the subsidy made a purchase, then this is including that 25 lakhs. The sales of holding includes the sales value. The selling price is a cost to this subsidiary company, so his cost of sale also includes the 25 lakh. So both the sales of the parent and the cost of sales of the subsidiary, both of them are including the 25 lakh rupees. I'm not talking of 20 lakhs. So what I'm going to do, I will eliminate this 25 lakhs from the revenue. I'll eliminate this 25 lakhs from the cost of sales as well. This is eliminating the intercompany sale and purchase. But just imagine, if you eliminate 25 lakhs from the revenue, you eliminate 25 lakhs from the cost, what is the impact on the profit? Nothing. You're eliminating mathematically a common figure from the sale, a common figure from the cost of sale. The impact on the profit is zero. So now what I need to do, watch this carefully. We will add the profit element, the stock reserve, to the cost of sale. We will add the unrealized profits out here to the cost of sale. Now you would immediately tell me, sir, can't you reduce 20 lakhs? You are saying I'm going to reduce 25 and then I'm going to add that 5. So it is as good as a reduction of 20. Why don't you directly take 20 lakhs itself? No. I'll tell you why. I'll tell you why. Hear this very carefully. Basically, this 25 lakhs which I'm reducing is the elimination of 100% of the sales. But the element of profit which I'm adding is supposed to be only stock reserve on unsold goods. It is only on the unsold goods. In my example right now, I'm assuming that all the goods are unsold in nature. Let's imagine 50% of the goods have been sold to a third. This went a little technical, I guess. When I say technical things, my system also gets angry on me. Okay, so as I said, right now the entire goods are unsold. Though technically speaking, what I've done, I'm reducing the 25 lakhs, which is 100% of the intercompany sale. So the elimination will always be 100%, even if goods have been sold to a third party. But when you add the profit element, it is only the profit on the unsold goods. So if 50% goods were unsold, I would have added only 2.5. So never consider that I will reduce the cost of the goods from the cost of sale. No, I will reduce the sales value 100%, add the profit element only on the goods which are yet unsold. I hope, friends, I stand clear on my thoughts. Now, see the impact of this particular item. Once you do this, you can see the impact. So the sales is 200 plus 100 minus 25. That works out at 275 lakhs. And when you take the cost of sales, 80 plus 45 minus 25 plus 5, this is 105. So you can see that out of this 25 lakhs is eliminated. Out of this only 20 lakhs is eliminated. So the profit automatically will get reduced by the amount of stock reserve. And this treatment would remain the same whether it is upstream or it is downstream in nature. Let me also make this very clear that this treatment as of now remains the same whether it is an upstream transaction or it is supposed to be a downstream transaction. That would not make any differences in this case. So unlike a balance sheet where the concept of upstream and downstream plays a different role, in terms of income statement, the treatment is common. Elimination of the sales from both the sales and the cost of sale, and adding the unrealized profits on the unsold goods to the cost of sale. This indirectly takes care of the adjustments as far as unrealized profits are concerned. Great. So this is going to be the focus number 2, aggregation of income and expense. Now comes the focus number 3. At the moment, I'm just giving you 3 focus points. So let's see the focus point number 3, what we're going to do in the consolidated income statement. So first is focusing on the date of acquisition. Second is the stock reserve or the unrealized profits. Now, the third and the most important focus point. When you get the profits, let me, again make a columnar information. So let's say you made a consolidated income statement. So one column for the holding, one for the subsidiary, adjustments, and the total. So this is holding company, subsidiary company, adjustments, as well as the total. Now you made your entire consolidated income statement and you've achieved a figure of profit. So we've taken all the incomes and expense and we get the figure of profits out here in the total column. Now, what is this total profit? If you technically ask me, what is this total profit? It is supposed to be holding company's own profits, plus I would say subsidiary companies post-acquisition profits. I would say if you technically ask me, what does this profit represent? I would say it is holding companies' own profits and subsidiary companies post-acquisition profits, because we aggregated only the post-acquisition income and expense. Now, at the end of the day, if you ask me, can I say this profit is to be split between? This profit is to be split between, you can say, the holding company and the NCI. Because ultimately, this profit belongs to the parent company. This, of course, belongs to the parent. Out of the post-acquisition, a portion belongs to the parent, a portion belongs to NCI. So once you reach your consolidated income statement at the end, this profit is to be split between, we can say, what is the profits attributable to? We need to split between what is the profits which is attributable to, you can say, the NCI as well as the holding company. So what I'm going to do, as far as the NCI is concerned, I'll compute this figure. As far as the holding company is concerned, I can comfortably take this as a balancing figure. So in the sense, I need to put it out here. I think least it creates a confusion. Let me stretch the arrow. So as far as the NCI is concerned, I'll compute this figure. And as far as the parent is concerned, I'll take it as a balancing figure. So let's say if this figure is appearing at 2 lakhs, I will calculate the NCI. Let's say it comes to 40,000. The balancing 160 belongs to the parent company. So we will have to compute what is the share of the NCI in this particular profits. Now, that is my third focus. So when you say that I'm going to compute the share, I'm going to compute the share of the NCI in the profits. Now the question arises, is the NCI going to get the profit share in the subsidiary which is reported by the subsidiary? Or do we need to make some rectifications as well? Watch this and hear this carefully. So when you're considering the share of the NCI in the profits of the company, so do we consider the reported profits of the subsidiary company, or do we need to make some adjustments? We need to make adjustments. I'll tell you how. The subsidiary company reported a certain profits, but there might be some additional depreciation due to fair value adjustments, which is not taken in the standalone financial statements. So I cannot afford to give the NCI a share in the reported earnings of the company, because the reported earnings of the subsidiary is without considering any additional depreciation. There was a fair value adjustments due to which there is additional depreciations. So you need to make a reduction on account of that. So which means that the NCI will be given a profit in the rectified earnings. So let me put the focus. NCI will get share in, I'll put it very clear, rectified profits. He will get a share in the rectified profits. And let's put it very clear, not the book profits. I will not consider the book profits of the subsidiary. We will consider the rectified profits. Now, what kind of rectifications are required to be done? I think let's put that also across. The rectifications which will be required, I would say, basically 3 adjustments. When you say that you're going to make a rectification of the profits, I would say basically a total of 3 adjustments. Number 1, the additional depreciation due to fair value adjustments. You can say the goodwill impairment if the NCI is at a fair value, because when the NCI will get a profit share, I will say that there is a goodwill impairment. If it is at a fair value, you need to bear the loss of impairment. And number 3, you also need to eliminate the stock reserve, which is upstream, not downstream. So there will be 3 adjustments which will be taken care. One is the stock reserve, which is upstream. One is the goodwill impairment. But this is going to be only if the goodwill is full. And the third one is making a reduction on account of additional depreciation due to fair value adjustments. I think let me connect the dots. So I have given you a total of 3 focus points in terms of consolidated income statement. Don't worry, we'll do a question as well. But first, I need to create a mind map in your mind. So let me just quickly consolidate the learning points. When you make a consolidated income statement, your first approach in the question is looking at the acquisition date. Why do we need to look at the acquisition date? Because you need to consolidate the post-acquisition period. If your acquisition date is much before the current year, it's not in the current year, it's before the current year, entire 12 months is post-acquisition, you can aggregate all the incomes and expense 12 months. But if the acquisition date is somewhere in between the year, then your consolidation will be proportionate number of months. From the acquisition date till the balance sheet date, you will consolidate income and expense proportionately. So this will tell you that consolidation is done for 12 months or the consolidation is done for less than 12 months. That's one focus point. The second focus point is more to do with the adjustments, that is unrealized profits. There is a need to eliminate the unrealized earnings. Now, when you consider the unrealized earnings, elimination, right now it does not make a difference. It is upstream or downstream in nature. I'll just keep it very simple. You need to reduce the common sale from both revenue and the cost of sale. You can see we eliminated the common figure from revenue as well as from the cost of sale. But we need to add the stock reserve to the cost of sale. But that stock reserve is not the total profit. The stock reserve is the profit on the unsold goods. The elimination of the intercompany sales is 100%, even if all the goods have been sold to third party. But the stock reserve will be added only to the extent the goods are unsold. If all the goods have been sold, I'll just eliminate the intercompany sale purchase, no addition in terms of stock reserve. And the third focus point, once you reach the profits of the consolidated income statement, it is to be divided between the parent and the NCI. So three focus points that when you give the share to the NCI will get a share in the rectified profits and not on the reported profits of the company. So the subsidy would have reported the profits in its standalone financials. There are three adjustments required to convert the reported earnings into rectified earnings. Goodwill impairment if NCI is at a fair value. Then there is going to be additional depreciations because of fair value adjustments and the elimination of the stock reserve. So all these three things will be subtracted. The goodwill impairment will get reduced, the stock reserve upstream will get reduced, and we will also make a reduction on account of additional depreciations due to fair value adjustments. I think if you keep these three focus points, consolidated income statement is not a big agenda. But before I go to now a question on a consolidated income statement, let's also consider all the other four adjustments as well. Because we need to be clear that what is the role of all those five adjustments in the consolidated income statement of the company. Then I think we're ready to do a question on this area. So let me do one thing now. Let me just make a small little chart. So I'm going to make a summary chart of all the adjustments from the point of view of consolidated income statement. So we're looking at the adjustments and the accounting treatments of all these adjustments. So this is going to be a summary chart. You can say of all the adjustments from the point of view of consolidated income statement. So we're looking at all the adjustments. The same five adjustments which I talked in balance sheet, we're talking the same adjustments in the income statement. So we've got adjustments. And let's see what is the accounting treatment. Let's see what is the accounting treatment in terms of consolidated, I'll put it as P&L, consolidated profit and loss. Number one. The first adjustment was intercompany owings. The first adjustment is intercompany owings. Now, intercompany owing means a common debtor creditor. Now, common debtor creditors is a balance sheet item. It's not an income statement item. So even if I give you any intercompany owings, can I say it has got no impact? It has got no impact in terms of consolidated P&L. So this is irrelevant. So this is absolutely irrelevant in nature. Now let's talk about another adjustments, and that we have just talked about, and that is the stock reserve. Whether it is upstream or it is downstream in nature. Whether it is upstream or it is downstream in nature. Eliminate the common sale from both the revenue and the cost of sale. So we can say we will eliminate we will eliminate, you can say, 100% of sale from both. We will eliminate 100% of the sale from both the sales and the cost of sale. So we'll eliminate the 100% of the intercompany sale from the revenue and the cost of sale. And number two, we will add the stock reserve to cost of sale. And this is only on unsold goods. This is only to the extent of unsold goods. So we will say that whatever is the stock reserve on the unsold goods, that is going to be added to the cost of sale. Next, the third input is, you can say, the additional depreciation due to fair value adjustments. And I think that's going to be simple and straight indeed. If you're looking at additional depreciation, you just need to increase the depreciation expense in the consolidated P&L. So we will basically increase depreciation expense. I'll just increase the depreciation expense in the consolidated P&L. That's it. Just charge that expense as a part of the depreciation expense. Number four, if there is any goodwill impairment, so what will I do in terms of goodwill impairment? Can I say just book the expense? Whatever goodwill impairment is there, just book that expense in the consolidated P&L. So the two adjustments, third and the fourth, is pretty simple. Any additional depreciation will be booked as an expense. Any goodwill impairment will be booked as an expense. And once I'm booking the goodwill impairment, I'm not thinking that it is partial or it is a full goodwill. Whatever goodwill impairment is there, we'll just book that as an expense. And then comes, there is omission. And then comes, if there is an omission. And the omission could be, typically, I would say in terms of deferred consideration. Any wild guess you would like to make that if there is an omission on account of deferred consideration, what impact would it have on the income statement? A company omitted to record the DC, the deferred consideration. So what do you think will be the impact on the income statement of the company? Any single word for that? Can I say this would lead to a finance charge, unwinding of discount? So this finance charge will also be booked as an expense in the profit and loss of the company. Great. So I think that takes care of all these adjustments which we did in the balance sheet. We can see in the income statement as well. And you can see the main adjustment is the stock reserve. Because as far as depreciation is concerned, goodwill impairment is concerned, or omissions of DC is concerned, is just increasing the expense. That's it. But I think the only caution is the unrealized profit adjustments. Rest is all simple and straight. I think now we are in a position, having conceptually understood the income statement, we can do a question on this area. Okay, so that's right. I think now let me just add on a question. I am just going to add a small little question from my side. So I've just, taken a question from my side. I'm going to share that question to you, which is containing almost a good level of adjustments. So let me just zoom this across to you. I've just taken a question of my own, so that we can get a couple of good adjustments can be seen. So let's have a look at the question number 1. And there are a couple of adjustments as well. This will give you a complete feel of how the consolidated income statement is going to be presented. Okay, so I think let's begin the journey. I hope this is not containing an associate, I guess. No, I think it's not containing an associate maybe. Let's read. Okay, It says Navya bought 75% of Mira on July X8, and it has got 80% of lien for many years. And we given the profit and loss statement for December X8. I thought let's take a question, which captures all the thoughts in a single question. And you can see that there are two subsidiaries. Now, let me ask you a very first quick question at the moment. It acquired 80% shares of lien many years ago. So can I comfortably say that in terms of lien, the entire current year is post-acquisition? Is the thought correct? Because when you acquired the shares in terms of lien, that was many years back. Great. And in terms of Mira, when you acquire the shares on 1st July, can I say only 6 months is going to become post-acquisition in this case? That is my first focus point, that I will consolidate only the period of post-acquisition. Wow. So there are two subsidiaries, but you need to be careful that in terms of both the subsidiary, one is completely post, another one is 6 months post. Wonderful. Now this gives me the income statement. Let me now read the additional information as well. It says on 1st July, an item of plant in the books of Mira had a fair value 20,000 in excess of the carrying amount. Can I say that is supposed to be a fair value adjustment? At this time, the plant had a remaining life of 5 years and the depreciation is charged to the cost of sale. So this is a fair value adjustments leading to additional depreciations. So we will take care of that additional depreciation in the respective expense cost of sale. Then he says during the post-acquisition period, Mira sold goods to Navya. Now, Mira sold goods to Navya. So what is the sale? Is it up or is it down? Navya is the company which has got stake in the other companies, and this is a sale which is made with a subsidy to the parent. It is upstream in nature. Wow, that's correct. And then it says 1/4 of the goods remained in the inventory at each year end, and the company is selling goods at a margin of 40% on sale. So this is relating to stock reserve, which is upstream in nature. So fair value adjustments is there. And then there is also the case of unrealized profits. Goodwill on the acquisition, which has been measured using a fair value method, which means it is supposed to be a full goodwill because we've taken a fair value method. It is to be impaired by 1,000 at year end. Impairment losses, it says, to be taken as a part of the operating expense. So goodwill impairment is also given. Then he says on 1st October X8, Lean paid a dividend of 5,000 and Mira paid a dividend of 4,000. The subsidiary companies paid a dividend. If the subsidiary companies paid the dividend, the parent must have received this dividend, and that requires an elimination of the intercompany owings. This is receivable from the parent's point of view. We are required to prepare a consolidated statement of profit and loss for the year ended December X8 for the Navya Group. Okay, so I think now we can see that there are a lot of adjustments. We've got the stock reserve adjustments, the goodwill impairment, and we are also given the adjustments as far as fair value additional depreciation is concerned. Intercompany owings as it is has got no relevance. So I think it contains almost all the kind of adjustments in this case. Let's begin. So we'll first organize the data. Let's, I think, give the answer. So I'll first make a columnar information to get it very clear. So we'll make a column for particulars. Now there is one column for the parent company, and there will be two columns for the subsidiary. And there will be one column for adjustments and one column for the total. So making this completely on a columnar format. So this is the consolidated profit and loss. So the parent company is Navya. And the other two subsidiaries is Lean and Mira. So this is Lean and this is Mira. Then there is a column for adjustments and we get the total as well. Now, as we proceed with item by item, we're going to just focus on that what is to be adjusted in the adjustment column. Let's begin. First, let's put the focus very clear that as far as Lean is concerned and as far as Mira is concerned, what is the consolidation? So it says as far as Mira is concerned, the shares are acquired on July X8. So as far as Lean is concerned, we will do the consolidation 6 months. And as far as Mira is concerned, we will do the consolidation for the full year. So you'll take 6 months figures for the first subsidiary and 12 months for the second. So let's begin with the data. So we're going to go one by one. So let's take the revenue. It is 214, 134, and 120. So we consider the revenue. This is 214. I forgot the figure. Then it is 134 and 120. 134 as well as 120. But when it comes to this, we need to consider 6 months. So I'm just written 134. So that you remember, we need to take 6 months. So 134 can be divided by 2. We'll take 67. Just to give you the focus that we're doing the consolidation 6 months. So consolidation is going to be for a focus of 6 months only. 6 months income, 6 months expense. Now we need to go to the adjustments and let's come to the point number 2. It says during the post-acquisition period, Mira sold goods to Navya. Right now, I'm not concerned it is upstream or downstream in nature. So the goods are sold for 10,000 rupees. 1/4 of the goods are unsold in the inventory. So let's also calculate the stock reserve at this stage. So the goods are sold to the extent of 10,000. 1/4 of the goods are unsold and the profit is supposed to be 40% margin. And that gives me the stock reserve calculations as well. So we can say on 10,000, 40%, 1/4 of the goods are unsold with a 40% margin, and that comes to 1,000. Remember, the figures are all in terms of thousands. This 10,000 is the absolute digit, but we've taken all the informations in the P&L in thousands. So let's go back. So we need to eliminate the sale that is 10. This is elimination of the intercompany sale. So 214 plus 67 plus 120 minus 10, that works out at 391. Okay, the next item we come to is the cost of sale, 130.86. It is 130.
How do we arrive at 391? Just
214 plus 67 plus 120.
correct, sir. Correct. Thank you.
The total, yeah. Okay, so this figure was, I forgot what was the figure. There was 86 and 72. So this is 86 and this is 72. This is the cost of sale. Now, very careful. Let's first take care of this adjustments and then proceed further. So this 10 intercompany is going to be eliminated and we're going to add this one. Let me just pinpoint, this is stock reserve. So you can see that we have eliminated the sale from the cost of sale and the revenue both, and we've added the stock reserve in the cost of sale. But I think there's something more which is there in the cost of sale. I think we need to take care of point number 1 as well. In terms of the point number 1, I am given. It says on July 1, the plant in the books of Mira had a fair value 20,000 in excess of the book value. At this time, the plant had a remaining life of 5 years. Would you like to tell me what will be the additional depreciation? Can I say on this 20,000, let's take the figures in thousands, 20, the remaining life is 5 years, so it comes to 4 is per annum, but we need 6 months depreciation. So can I say we'll take 2. So we need to consider additional depreciations only for the post-acquisition period, and that is July to December. So annual depreciation is 4, but we're going to consider 2, and that's a part of the cost of sale. So let's take this as a part of cost of sale plus 2. Just to pinpoint, that is the additional depreciation. Right, I think that takes care of the data. So let's take 130 plus 86 plus 72 minus 10, and this is going to be plus 3. This is 281. So it's not that technical like a balance sheet, but you need to be very careful in terms of what you're adding and what you're subtracting. Okay, so based on this, I am now going to get my gross profit as well. So let me do one thing. Let me get my GP, that is gross profit. So I'll take the GP figure out here. So 391 minus 281, this comes to 110. Then the next item which is given is the operating expenses in the P&L. So let's go to the operating expense. So in terms of the operating expense, I'm given 41. Oh, by the way, small little error again. This is 43. Aha. This was 43. Missed that out. 6 months data. So please rectify this. So continuously we need to consider 6 months data. 130 plus 43 plus 72 minus 10 plus 3, that's 238. So this works out at 153. Okay, so this gives me the GP. Now let's go to the operating expense back again. So this is 41, 27, and 20. This is 41. So instead of 27, we're going to take 13.5. And that was 20. So that works out at 20. So every time we're taking lean, we're taking 6 months data post-acquisition and the other company full. Now let's see if there is any adjustments on account of the operating expense. I think point 1 is done, point 2 is done. We've taken care of the depreciations, we've taken care of the stock reserve. Now the point number 3. Goodwill, it says, is measured using a fair value and it is impaired by 1,000 at the year end. And it says the impairment losses can be taken as a part of the operating expense. So let's take the impairment 1. So we take the impairment is to the extent of 1. Let me just make a mention for your reference later. This is the impairment as far as goodwill is concerned. So this is going to be 41 plus 13.5 plus 20 plus 1, 75.5. Right, so this is going to give us the operating profit. I'm going with the format which is given in the question as it is. So this is going to give us the operating profit. So the operating profit is 153 minus 75.5, that's 77.5. I think typically all the adjustments are taken care of. Then let's go further. Then there is an investment income 8. So we've got investment income. Now, there is something interesting on the investment income as well, because we are given some data regarding the investment income in the additional information. So point number 1, 2, 3 is done. Then on point number 4, on October X8, Lean paid a dividend of 5,000 and Mira paid a dividend of 4. So can I say out of this dividends, the parent company will receive this dividend. So that investment income of 8 is including the dividend they received from the subsidiary company. So let's see the percentage. So it has got 75% in Mira and 80% in Lean. 75% in terms of Mira. So 75%, 75% in terms of Mira, 75% in Mira. So 75% of this would be received and 80% of this would be received. So let's consider 80% would mean 4, 75% would mean 3. So we've got the dividend. This is in the adjustments, minus 4, and so we eliminate that 4 and we eliminate that 3. So this is as far as the dividend incomes are concerned. So when the subsidiary paid the dividends, the parent company received the dividend and it's captured as a part of the investment income. So that also gets eliminated. So this is going to be 1. I think that's it. Nothing else is given. Let me just go back to the format. And this is going to give me the profit before financing, but this is as good as PBT. So I think let's call this as good as PBT. So let's see what is the profits before tax. So this is 78.5 is the profit before tax. Let's, I think, continue this further. Let's continue with the formatting. So columnar profit and loss. So we've got 1 column for the parent, 2 columns for the subsidiary, 1 column for the adjustments, and the total. So we've got Navya, rather, Lean Mira. This is Lean, this is Mira, this is adjustments, and this is total. Let's consider the PBT, and that's, I think, 78.5. Let's go back to the profit and loss and see the data once again. So let's go back and see the data once again. So I think now we're just given the income tax, that is 12, 5, and 6. So there is income tax. So there is income tax 12. Then this is 5, which will be taken 6 months, and this is 6. I don't think so there is any adjustments pertaining to this. So that is 20.5. So this will give us the profit after tax. This is the PAT, 78.5 minus 20.5. This is 58. Okay. Now I think it's time to go back to the additional information, see if there is anything else which is left over. Otherwise, this profit is to be divided between the NCI and the parent. So I think if we come back on the data now, so point number 1, depreciation done. Point number 2, stock reserve intercompany sale done. Point number 3, goodwill impairment done. Point number 4, eliminations of the dividend incomes done. Everything is taken care, so there is no further adjustments. Now we need to split this profit, that is PAT, between the parent and the NCI. So we will divide this. What is the profits attributable to? We will divide this. What is the profits which is attributable to the parent company that is holding as well as the NCI. So I'm going to calculate this figure of NCI. We're going to calculate this figure of NCI and take the parent company as a balancing figure as we decided. Okay, now let's calculate the share of the NCI. Now there are 2 NCI because there are 2 subsidiaries, so we need to work out this carefully. Let's go further. I need to calculate the rectified profits. I need to calculate the rectified profits of the subsidiary company in order to get the share of the NCI. And there are two companies. So first of all, we'll go for the reported profits of these company. First of all, we'll go for the reported profits of these company, convert this reported profits into rectified profits, and then give the share to the NCI. Let's go back on the reported earnings in the question. Now we can see the reported earnings is supposed to be 16 for Lean and 22 for Mira, 16 and 22. So this is 16 and 22. So this is Lean 16, but we'll take it as 8, and Mira is supposed to be 12. Because we need the profits which is for the post-acquisition period. So in terms of Lean, we need to consider 6 months. Lean was 6 months, right? Yes. So Lean is supposed to be 6 months. No, Mira is supposed to be, Lean is supposed to be many years. I think I messed up with the figures, I guess. Nobody stopped me on that as well. Lean is in the middle of the year. That's for many years. And Mira is 6 months. Oh my God. Now you want me to do the rectifications or continue like this?
Continue like this. Continue like
Okay.
this.
I think that's better. So in this case, I've taken 6 months for Lean together. So let's continue with 6 months only. Now we need the rectifications on account of 3 adjustments. One is the goodwill impairment. One is the element of additional depreciation. And one is the stock reserve. So let's consider these 3 adjustments back again. Let's go to the additional information. So we're given that Mira had this additional depreciation. Mira sold goods to Navya, and the goodwill of Lean is taken so and so. So we'll take the goodwill in the column of Lean. Goodwill is in the Lean's column. This was impairment 1. Additional depreciation was how much? And stock reserve how much? So my additional depreciation, stock reserve is 1, and additional depreciation is 2. So additional depreciation is 2 and the stock reserve is 1. Let's get the rectified profits. So this is going to be 7 and this is going to be 9. Now we can consider the share of the NCI. So if we take the share of the NCI, Mira is 25%, Lean is 20%. So Lean is 20% and this is 25%. Let's see what is the share of the NCI in the rectified profits. So these are the rectified profits of the company. So 7 into 20%, 1.4, 9 into 25%. I think the total is 3.65. So this gives me the rectified profits of the subsidiary company, that is 3.65. Now this can be fitted out here, 3.65, and the balancing figure, that is 54.35, that belongs to the parent company. Right, so that's how the consolidated income statement is going to be taken care in this case. All the adjustments, consolidated income statement done. If you compare the intensity of the balance sheet versus income statement, I think income statement is far more easier. Except that, you just need to be very, very involved with the question that what is to be added or subtracted from which place. Once you reach the division of NCI, you need to be careful that, okay, I need rectified earnings and not the book earnings. Otherwise, I think procedurally, it is much easier compared to the balance sheet. Right, friends, so this is done. No worry, we'll maybe come back to the income statement with an associate company also later. But for the time being, my concept of the income statement is done. Now, balance sheet is done, income statement is done. Right, so now we go to the block number 3. I hope you're comfortable with the technique of consolidating income statement. Quite some days asking you the comfort zone on a scale of 10. So what do you say on a scale of 10? What is the comfort zone on the consolidated income statement? Then I think we can take the journey forward. 9, that's wonderful indeed. So let's now go to the third block in this case, which is again very, very easy indeed. So let's come to the third area of 110. That is my block number 3. So as I said, the third block is the other aspects. And in other aspects now, we're looking at changes in the ownership interest. I'll make your life simple. How do you tackle the changes in the ownership interest? So first, let me give you the overview in terms of what do we mean by the changes in the ownership interest. So we're talking in terms of changes in ownership interest. We're talking of changes in the ownership interest. Now, when I say that there is a changes in the ownership interest, I would say there are broadly 2 cases. One is that it results in a further acquisition, and the other one is it results in a disposal. So I would divide the entire discussions in 2 parts. One is, you can say, a further acquisition, and one is, you can say, a disposal. So let's divide this in 2 parts. So the first one we can say is a case where it is a case of, let's say, a step acquisition. The second one is a case where we can say it is a case of disposal. It is a case of disposal. Now, this is one way of looking at things, and another way of looking at things is that you see, once an action takes place, it leads to loss of control, or it does not lead to loss of control. So there is another way of looking at the same thing. Another way of looking at is that there is no loss of control. There is no loss of control, or we can say there is going to be a loss of control. There can be a loss of control. So this is one way. There are 2 different ways of looking at this. I would prefer this, segregation. Now you would say, what is the difference? If you say it is a step acquisition, it will not lead to loss of control. And if it is disposal, it will lead to loss of control. Not necessary. When you dispose the shares, let's say, for example, I have an 80% stake and I sold 10% stake, I'm still having a 70% stake. So there is no loss of control. So there is a possibility that disposal may lead to loss of control, or it may not lead to loss of control. So I think the better way of looking things is that when there is a change in the percentage of holding, as an investor, you've got a stake in the investee. So when you take an action of either selling shares or buying shares, it could lead to loss of control. That means you're out of Ind AS 110, or it leads to no loss of control. You're still under Ind AS 110. So let me give you now some broader permutations combination. So first I'll give you some broader permutations combinations. So we're looking at one case, there is no loss of control. So when there is no loss of control, I would say there can be 2 permutations combination. One is a case where there is a further acquisition. One is a case that there is a further acquisition, and one is a case where there is a disposal. Let's take an example. We had a 75% stake and we acquired another 10% stake. So there is no loss of control. From 75, you reach 85. So 10% more. You were in control, you're still in control. Disposal would be something like this. You had a 90% stake, you sold a 10% stake, so you're still in control. So whether it's a further acquisition, the control is still there, whether it is a disposal, the control is still there. So these are the two combinations when there is no loss of control. The other one is that there is a loss of control. The other one is that there is a loss of control. Now, I would segregate when there is a loss of control in terms of two broad area: full disposal, partial disposal. You sold all the shares or you sold only a percentage. So loss of control will never consider a further acquisition. So we can say there will be two combinations. One is you can say there is a full disposal. And one is that you can say that there is a partial disposal. Now, when you say that there is going to be a full disposal, I think just to make a mention, this is like you had 80% stake, you sold all the stake and you left with nothing. So that becomes nil. When you say it is a case of a partial disposal, there can be a lot of other permutations, combinations as well. So when you say it is a partial disposal, there could be, I would say, one case where the control continues. There can be another case that you convert from control to a significant influence, that is Index 28. Or the third one is that you become a passive investor. So you sell so many shares that you lose control. And in this particular case, when you say you lose control, or rather control continues, would be this. So we can say that it converts. We can say that it converts into associate company. So partial disposal, you're out of Index 110, but you enter Index 28. You convert into associate. So say, for example, you had an 80% stake. You sold in such a way that you've got now 25% stake. Conversion from a subsidiary into an associate. Or we can say it becomes a passive investor. Or we can say you become a passive investor. Now, when I say you become a passive investor, it could be something like from 80%, you sold the stake and you left with only 70%. So you can see the permutations, combinations 1, 2, 3, 4, 5. Apparently, it seems quite complicated indeed. That when you're looking at a case where there is no loss of control, it's either a further acquisition or it is a disposal, but the percentage which is left over still indicates that you are in control of the company. Or it is a case of disposal where you sell 100% of the shares, that is full disposal, becomes zero. Or you partly sell it and you become an associate company, or you become a passive investor. But trust me, irrespective of the combinations you see, the accounting treatment to me is only two types. In a situation where there is no loss of control, that is one. And in the situation where there is a loss of control, there is two. Irrespective of any of the permutations, combinations, the accounting treatment will remain the same. So what I'm going to give you is only two cases. If there is no loss of control, what kind of entries are done? If there is a loss of control, what kind of entries are done, irrespective of any of these permutations, combination? Let's have a look. Now, let me tell you, I am giving you the journal entry. I am giving you the journal entries for the changes in ownership in the consolidated financial statements. These entries which we're doing is in terms of consolidated financial statements. So all these entries which I'm giving to you is from the point of view of the consolidated financial statements. If you buy shares and you're looking at standalone financials, normal entry for acquisition. If you're looking at standalone financial statements and there is a disposal of shares, normal entry for sale, bank debit, investment credit, calculate the profit loss. So the idea is not to give you the entries in a standalone financials. The idea is to look at entries in the consolidated financial statements. So let's do one thing. Let's divide this in terms of two blocks. Let's divide this in terms of two blocks. So we can say that there is no loss of control. There is no loss of control, and one is there is a loss of control. I think first let's make your life simple. If you say that there is a loss of control, I don't care whether it is a full disposal, whether it is a partial disposal, conversion to associate, conversion to passive investment, irrespective of common treatment. Now, let's analyze this carefully with logic. When you acquired a control under Ind AS 103, what did you do? You put in acquisition entry. Because when you acquired a control, you did the acquisition entry. Now, if you lose a control, you do one thing, reverse that entry. As simple as that. Which means in a situation where the control is gone, I will simply reverse the acquisition entry, which I did in Ind AS 103. So trust me, in this case, what I'm going to do, I will put a reverse entry. I'll put a reverse entry, which we did in acquisition accounting as per 103. I will put a reverse entry altogether. So what entry you did at the stage when the control was acquired, I'm just going to reverse that entry directly. So see what we're going to do. If you remember the entry at the time of Ind AS 103, the entry was assets got a debit, liabilities got a credit, PC got a credit, NCI got a credit, and goodwill was the balancing figure. Now, debits will become credits, credits will become debit. So what I'm going to do, liabilities will be given a debit. NCI will be given a debit. Assets will be given a credit. Goodwill is going to be given a credit. Investment retained, if any. This is the investment which is retained, if any. That will be given a debit. So what I'm going to do in this particular case, the investment retained will be given a debit, liabilities de-recognize, NCI de-recognize, assets and goodwill all de-recognize. Done the simple entry. And of course, we'll also take bank debit. Because you're selling the investment, so bank will also get a debit with the sale proceeds. The liabilities, the NCI, everything, this will be taken as on the date of sale. All these values will be taken on the date of sale. The liabilities will be de-recognized based on the value on the date of sale. NCI will be de-recognized based on the value on the date of sale. Assets, goodwill, everything will be taken as on the date of sale. And then once you get a balancing figure in this entry, the balancing figure in this entry is a gain or loss which will be taken in the P&L. As simple as that. Whenever you see that there is a disposal resulting in a loss of control, whether it is a case of full disposal or a case of partial disposal, just remember, bank gets a debit with the sale proceeds. Investment retained, if any, gets a debit in this entry. Rest you need to de-recognize. Liabilities, debit to de-recognize. Assets, credit to de-recognize. Goodwill, credit to de-recognize. NCI, debit to de-recognize. And any balancing figure is a gain or loss which is taken in the P&L. That's it. Now let's come to the case where there is a loss of control. No loss of control. When there is no loss of control, it is either a case of further acquisition or it is a case of disposal. So here we are looking at two different cases. One is a further acquisition and one is a case of disposal. If it is a case where there is no loss of control, trust me, what the standard considers. It's like, the NCI is dealing with a controlling interest. There are two stakeholders, one who's got a control and one who's got no control. That's NCI. So they're dealing with each other. So when you're going to buy shares or you're going to sell shares, the NCI will change from the consolidation point of view. Since we're looking at the entries in the consolidated financial statements, any changes would mean a change in the NCI. So when there is going to be a further acquisition, NCI will reduce, so NCI gets a debit. And whatever you pay, the bank gets a credit. If there is going to be a disposal, then you get the money, the bank gets a debit, and the NCI will undergo a decrease. So we will put the entry bank debit, NCI credit. You said, but investment is already debited at the time of acquisition. No, this is the investment which is retained. This is not the existing investment. Because if it is a partial disposal and you convert from control to an associate, so this is the investment which is retained in the associate, captured at a fair value. So what you had debited earlier, that was the purchase consideration. Now what you're debiting, so you can say that PC credit is nothing, bank credit, equity share capital credit. So now what we're doing, this is the retained investment in case of partial disposal. Correct. Okay, and let me now tell you that if there is any balancing figure in this entry, this is going to be taken in equity, not in P&L. Because there are two shareholders which are dealing with each other. When you say that there is no loss of control, there are two set of people dealing with each other. They are shareholders of the company. One is the controlling interest, one is the non-controlling interest. They sit down and deal with each other. So any profit or loss can never hit the income statement. Any kind of, amounts which are paid to the equity shareholders like dividends is never captured in the P&L. It's taken directly in SOKI. Same is the logic which works out here, that if there is no loss of control, then any gain or loss is going to be a dealing between the shareholders of the company, and this gain or loss will be directly captured in equity. There is statement of changes in equity without hitting the P&L. Okay, so I think this gives me a conceptual understanding of how we are going to tackle the areas on disposal or further acquisition. Time to do some questions on this. So the basic thought is, when you look at the question in terms of changes in ownership, just focus, is it a case where the control is gone? Reverse 103 entry. If you see that it is a case where the control is still there, whether it's a further acquisition or disposal, just the change in the NCI and the balancing figure equity. Here the balancing figure is taken in the profit and loss account. Let's, I think, do some questions with you on this area now. So I have taken some questions on this area as well. Let me just share some questions which I have added. Yes, so we've got a few questions on this area. Let me just crop this. So we'll read the facts and decide what is to be done. I think I'll keep some space on the right-hand side. Hope this is visible. Correct. So let's, I think, read the facts of this particular case, and then we'll see what kind of entries to be done in this case. It says entity A acquired 60% of B 2 years ago, and at that time the fair value was 10,000. The entity's B's fair value was 10,000. It had got a net assets with a fair value of 6,000, which for the purpose of this example is same as the book value. Goodwill of 2,400 was recorded. He's shown the calculations of the goodwill. The purchase consideration paid is 6, and you get a 60% stake in the net assets. That gives you a goodwill of 2,400. Then he says on 1st October X0, entity A acquires a further 20% interest in the company, making the holding to 80. So we had a 60% stake, and then we acquired another 20% stake, and that makes it 80% stake. Is this a loss of control or no loss of control? 60 to 80 further acquisition, control was there and the control is still there. And that's right. So there is no loss of control. There is no loss of control. So we know that the entry is going to be routed through NCI. Then he says at that time, the fair value of the entity is 20,000. A pays 4,000 for 20% interest. At the time of purchase, the fair value of the net assets is given. And the carrying amount of the NCI is also given. Okay, so I think we are comfortable to put the entry. Can I say, since it is a case of loss of control, which is a case of further acquisition, can I say in this particular case, there is a need to decrease the NCI because we had a 60% stake, there was a 40% NCI. Now you get an 80% stake, so the NCI gets reduced. So we will put the entry NCI gets a debit, bank gets a credit, and difference will be taken in terms of equity. So he's very clearly said that A pays 4,000, so we paid a total of 4,000. And would you like to tell me what will be the decrease in terms of NCI? My NCI in the books is standing at 4,000. Can I say 4,000 represents that 40%? And now the NCI is 20%. Can I simply make it half? That 4,000 is the total NCI. And since you sold 50%, that's right. So 2,000 becomes the NCI. And we can comfortably take the balancing figure in this case. That will be taken as equity. So the balancing figure 2000 is taken to equity. So you can see rest all the data, whatever is given to us is completely irrelevant in nature. Because in this case, the control is still in continuation. There is no loss of control. It's simply a reduction of the NCI proportionately, and you make a payment and difference gain or loss is taken to equity. As simple and straight. Let's look at another question. So this is again a simple and a straightforward small little question. Let's do question number 3. So I'll read the facts and you can decide what is the kind of case. It says entity P sells 20% in a wholly owned subsidiary. So if it is a wholly owned subsidiary and you sell 20%, it comes from 100 to 80%. Is there a loss of control in this particular case?
No loss.
That's right. So there is no loss of control. By the way, is it the opposite of the previous question which I did? That was further acquisition. Can I say this is disposal,
Yes.
but there is no loss of control? I am given the carrying amount of the net assets, including goodwill, etc. Now, since it was a wholly owned subsidiary, there was no NCI. But when you dispose 20%, NCI will come into the picture. So the entry in this case is bank gets a debit. NCI will increase, so NCI gets a credit, and difference is going to be taken in terms of equity. So as far as the bank is concerned, we sold the investment at 100 lakhs. And would you like to tell me what will be the amount of NCI in this case?
20.
That's right. So 20? No, not 20. I mean the absolute figure. The net assets are 300 lakhs. So can I say out of this 300 lakhs, 20% belongs to the NCI? That makes it 60, correct? So there will be a balancing figure, which is going to be taken to equity. The profit or loss on disposal, that's taken in equity. Now, there is one thing which I did not make a mention earlier, but I think it's worth making a mention at this stage. In this entry, whether you debit the NCI or you credit the NCI, so can I say, irrespective, whether you debit the NCI or you credit the NCI, can I say the amount of NCI would either be a case of PASNA or a case of fair value? So you need to be careful that in these entries, when you say that the NCI gets a debit or a credit, can I say you need to watch out whether the NCI is at a PASNA or the NCI is at a fair value. Though in this particular question, there was no existing NCI, so that question did not bother us. But I think let me make a statement. If the NCI is taken at PASNA, can I say it will be recorded at the share in net assets without goodwill? Is that correct? When you go to consider that NCI is at PASNA, you will take the share in the net assets without the goodwill. But if the NCI is at a fair value, can I say we will take the share in net assets plus the goodwill? That means I will consider net assets plus goodwill and then take the share. Because if NCI is at a fair value, it would appear in the balance sheet at share in net assets including goodwill. But if NCI is at PASNA, it will be recorded at the share in net assets without goodwill. By the way, when it says the carrying value of the net assets is 300, including the goodwill. So when I recorded this NCI at 60, am I indirectly saying that it is at fair value or at PASNA? What do you say? And that's right, it is at a fair value because when you consider this to be 60, you're considering 300, which is inclusive of the goodwill. And when you take the NCI at the share in the net assets plus the goodwill, it is an indirect presumption that it is at a fair value. But if there is an existing NCI in the books of accounts, you need to also evaluate and decide and accordingly calculate the NCI. Okay, so that was simple indeed. Both the questions on no loss of control. Let's look at another question. Naturally, this is going to be on the case of a partial disposal. So far, we have done two questions. Both are on the case when there is no loss of control. One was on further acquisition, one was on disposal. Now, this is going to be on loss of control for sure. Let's have a read. It says a parent purchased 80% interest in a subsidiary on 1st April X1 when the fair value of the net assets is given. Goodwill is 20,000 on account of consolidation, and that is a partial goodwill. He's already given you the goodwill is 20, and that is partial goodwill in nature. Then he says an impairment of goodwill was taken to the consolidated financials year March X3. No other impairment charges have been recorded. The parent sold its investment in the subsidiary on March X4 for 2 lakh. The book value of the net assets in the consolidated financial statements on the date of sale, not including the goodwill of 12,000 is given. When the subsidiary met the criteria for being classified as held for sale under 105, no write-down was required because the fair value less cost to sell was greater than the book value. The parent carried the investment at cost permitted by Ind AS 27. This is for the purpose of separate financial statements that the investment is recorded at cost. Calculate the gain or loss on disposal in the separate financials and in the consolidated financials on March X4. As I said earlier, the entries which I'm giving you is all the entries from the consolidation point of view. The entry for the separate financials is done in a usual manner itself. But we'll see in this case, the entries both from console and separate. So let's, I think, first look at the consolidated financial statements. Now, once it says very clearly that the parent sold the investment in the subsidiary, so can we outrightly say that this is a case of loss of control? It's a full disposal. It's 100% disposal in this particular case. So it's a case of complete disposal in this case. So am I supposed to pass in reverse entry under 103? Yes. I'll first just note down the entry and then we'll just fill in the blanks to get the data. First, I'm just putting a comprehensive entry for disposal. So the entry is going to be bank gets a debit with the sale proceeds. Investment gets a credit. Investment gets a debit for any retained investment, if any, though there is no investment retained. Then the NCI gets a debit, derecognizing it. The net assets gets a credit. The goodwill gets a credit. And the balancing figure will be again a loss. So when you capture this entry, you can first put down the entry and then proceed further. So let's, I think, begin with the data. You can help me to get the information as well. What is the value at which investments are sold? The parent sold the investment for 2 lakhs. So can I say this is the bank figure? There is no investment retained, so that becomes 0. And what is the amount at which the net assets will be given a credit? The book value of the net assets in the consolidated financials on the date of sale. Can I say this is 2,25,000? And then it also tells me that as far as the goodwill in the books of accounts is concerned, it is 12,000. Everything is very clearly given. The sale proceeds are given. The net assets on the date of sale is given. The goodwill, which is post the impairment, is given. And what about the NCI? Am I given the status of the NCI in this case? It only says that the NCI is taken at Pasna. So if the NCI is taken at Pasna, can I comfortably take that the net assets on the date of sale is 225 into the NCI is 20%? Since we're looking at the NCI on the date of disposal, this is the net assets without goodwill. Mind you, this is the net assets without goodwill. So we're taking 20% of this. That works out at 45,000. And I think now we can get the balancing figure in this entry. Let's see what is the balancing figure. I guess we're getting a balancing figure 8,000. So that will be taken in the profit and loss, the gain on disposal in the consolidated financial statements. Right. So this is one part of the question, calculating the profit on disposal in the consolidated financials. Now let's see. If I were to calculate the profit or loss on the separate financials, let's also make a simple calculations on the separate financials as well. Can I say in the separate financial statements, we'll simply compare the sale proceeds versus the original cost of the investment. So we made a sale of the investment at 2 lakh rupee. And what is the original cost of the investment? Can I say we made a purchase of the investments at 1,60,000? So there is going to be a profit on sale 40,000. That profit on sale will be taken in the P&L. So if you want to look at the entry as well, it's going to be bank gets a debit, that is 2 lakhs. Investment gets a credit, that is 1.6 lakh. And there will be a balancing figure that is 0.4 lakhs, which enters the profit and loss of the company. So this is the entry for the standalone financials, and this is the journal entry for profit and loss on the consolidated financial statements. Okay, so I think now we can do a little more comprehensive question on this area. This is partial disposal. Okay, let's take another question as well. Question number 5. Let's see the question number 5. Okay, now I am given out here A purchased 100% subsidiary when the fair value of the net assets is given, and therefore the goodwill is 10 lakh. Since it's a full control, so you can directly compare the PC versus the net asset, 50 versus 40, you get a goodwill of 10. A Limited disposes 90% interest. So from 100%, there is a disposal of 90%. So you're left with only 10%. Can I say this is undoubtedly a case of loss of control? By the way, which case is this in specific? From 100 to 10%? A case of conversion to passive investment, correct? This is a case where you're converting to a passive investor in this particular case. Okay, it says it disposes 90% interest for 85.5 lakh, leaving a 10% investment. At the date of disposal, the carrying value of the assets, excluding goodwill, is given. The fair value of the remaining interest, that is 10%, is given, assumed to be proportionate of that 90%. Calculate the gain or loss on sale in the separate and in the consolidated financial statements. So let's first look at the consolidated financial statements. So let's see the detail on consolidated financials. Now, since it is a case of loss of control, undoubtedly we need to put a reverse entry of 103. So let's first put a generic entry and then fill up the data. So bank gets a debit with the sale proceeds. Investment retained gets a debit. NCI gets a debit. Net assets and goodwill gets a credit. And the balancing figure, gain or loss, will be taken in the P&L. So let's consider the data. So what is the value at which investments have been sold? It says the investments are sold at 85.5 lakhs. The 10% investment which is retained has got a fair value, that is 9.5 lakhs. And as far as the net assets are concerned, very clearly given, the net assets on the date of disposal is supposed to be 80 lakhs. And goodwill is already given, that's 10 lakhs. And what about the NCI? So would you like to tell me what will be the NCI? So is there any NCI? It was 100% subsidiary. So can I say if it was 100% subsidiary, there was no NCI in the books? So let's see the balancing figure, gain loss. 85.5, 9.5. So I think there is a balancing figure 5 lakhs that will be taken in the profit and loss. Well, so this is done. So this is on the consolidated financials. Let's also look at the profit and loss on the separate financials as well. So let's see what is the position in the separate financials. So we made a sale. I think we can put the entry, bank gets a debit, investment gets a credit, bank is to the extent of 85.5. And I think you can give me what is the value of the investments. Let's, I think, get this from you. We made a purchase of investments at 50 lakhs and 90% of the investment is sold. So what will be the book value of the investment in separate financials? Can we take it pro rata? 90%? Of course, yes. So that would be 45 lakhs because 50 lakhs is the cost of 100%. So we can say 90% is 45. So we get the balancing figure that would be in the profit and loss. That is 40.5 lakhs. So this gives me the profit from the standpoint of separate as well as consolidated financial statements both. Now, there is another very interesting case. If you notice, we've covered like almost all the permutations, combinations. We covered the case of no loss of control, further acquisition, no loss of control, disposal. We covered the case of conversion, a full disposal. We covered the case of conversion to an associate as well. Conversion to passive. The only case left over is conversion from a passive, from control to an associate. Now, I don't know whether we should do this case at this stage or not, because I think you need some insights upon the associate part. So I think either we come back to that particular case later, because at this stage, without understanding how does an equity method apply, we may not be able to visualize the impact that when you sell a company and it converts from a subsidiary to associate, how is it tackled? So what do you want me to do? Later, I guess. I think we'll first pick up the concept of Indus 28, and then we can maybe come back to the agenda of conversion to associate, right? I think that makes more sense, right?
Yes,
Yes.
sir.
Great. So anyway, this is the question. I'm not removing that question. I've already retained that question out here. So anyway, I think what we've done is now we are done with Indus 110. Now we're going to switch over to Indus 28. Now, in terms of Indus 28, I had given you some basic flavors earlier, but now we're going to go to the comprehensive level of Indus 28 today. Once I'm done with Indus 28, I will also try to pick up a question, balance sheet, subsidiary, associate, both. That means making a consolidated balance sheet when there is a subsidiary and associate, and also considering a consolidated income statement, subsidiary and associate. I'll also make a summary chart after this that, after the Indus 28 is done, where you get a comparative position of all the five adjustments in terms of balance sheet, in terms of P&L, in terms of subsidiary, associate, all put together. That would be after we've done with Indus 28. But I think let's first give you a break, and then I think we can start a journey in terms of Indus 28 after the break. So let's take a break. We'll start back after that, friends. 10, 12 minutes. I'll start back. ब्रेक लगा दीजिएगा जी। हाँ जी, थैंक यू। I hope you had a relaxation of mind. So ready to start with a new standard on consolidation, and that is Ind AS 28. Now, I think first I'm going to make some background on the concept of Ind AS 28 before we take the journey forward. So I'm going to share the study material to you on the screen. And we'll first make some inputs regarding the standard. This is the unit number 6, I guess, in the study mat, which talks about the investment in associate. Let me just slightly crop this. So this is unit number 6. I hope that's pretty much visible indeed, I guess. Now, let me, I think, first of all, read the name of the Ind AS 28 out here. It says investment in associate and joint ventures. I think in the first instance, we need to understand and appreciate one very important aspect. There are basically 3 standards dealing with consolidation. One is Ind AS 110, one is Ind AS 111, and one is Ind AS 28. We're yet to cover Ind AS 111. But I think let me pinpoint something that once you apply Ind AS 111, when you apply Ind AS 111, it's called joint arrangements. Basically, a joint arrangement stems out of what we call a joint control. We'll not get into what a joint control is because that assessment is made under Ind AS 111, but you can say 2 or more investors control an entity jointly. Now, once you establish that there is a joint control, it becomes a joint arrangement. Now, further, this joint arrangement is classified as per Ind AS 111 in terms of what we call a joint operation or a joint venture. That means in terms of applying Ind AS 111, the stage number 1 is that you evaluate whether it is a joint arrangement. Once you evaluate and say, yes, it is a joint arrangement, the next stage is to segregate that is it a joint operation called a JO or is it a joint venture? If it is supposed to be a joint venture, you move out of Ind AS 111 and you move to Ind AS 28. The consolidation of a joint venture accounting is covered under 28 and not under Ind AS 111. But if it is a joint operation, the consolidation technique is defined in terms of Ind AS 111. Which means Ind AS 28 addresses 2 things. If there is a significant influence, I think I made that mention earlier as well. If there is a significant influence, it creates an associate. And if there is a joint control, it may lead to a JO or a JV. But if it leads to a JV, then it is covered under 28. So Ind AS 28 is covering 2 kinds of relationship. That there is a significant influence resulting in an associate, 1. There is a joint control resulting in a joint venture, 2. And therefore, the name of the standard, investment in associates and joint venture. I hope I stand clear on my thoughts. Let's read further. Now, as far as Ind AS 28 is concerned, just like Ind AS 110, I will divide my entire discussions in terms of 3 blocks. The first block I'm going to look at is the assessment of a significant influence. Just like Ind AS 110, the control is a principle-based assessment. It's not a rule-based assessment. Here also, in terms of Ind AS 28, when you evaluate a significant influence, it is not a rule-based assessment. Yes, invariably, we do say that if you got 20% or more than 20% voting power, you get a significant influence over the investee. But it's not a rule-based assessment. It is a principle-based assessment, which means you may not get a significant influence even if you've got more than 20% stake. You may get a significant influence even if the percentage is below 20%. So in block 1, we will look into the concept of how to assess a significant influence. The block 2, which is the main and the crucial block of this standard. How would the accounting, how would the consolidation occur as per Ind AS 28? And the technique of Ind AS 28 consolidation is called equity method. In terms of Ind AS 110, the technique was called full consolidation, because whether you had an 80% stake or a 100% stake, you always landed up doing a full consolidation. But in terms of Ind AS 28, this technique is called equity method of consolidation, which is also called one-line consolidation. Though the standard does not use the word one-line consolidation, the standard uses the term which is called equity method of consolidation. But once you look at the essence of the consolidation technique, you realize it is a one-line consolidation. Then I'm going to go to the block number 3, in which I will discuss the other aspects of Ind AS 28. And typically, we need to discuss the appendix of Ind AS 28. Where as an investor, I may have other long-term interest in the associate company as well. So how does the accounting of those other long-term interests get taken care? That is what we're going to cover. So in short, just to connect the points. I'm going to divide my discussions on Ind AS 28 in 3 blocks. The block 1 is the assessment of significant influence. The block 2 is the consolidation technique called equity method of one line. And the block number 3 is the other aspects. And that will take care of the journey in terms of 28. Let's begin with the block number 1. Now, it says very clearly in terms of the scope that Ind AS 28 is applied by all entities with investors with a joint control of an investee or a significant influence over the investee. The assessment of joint control is covered under Ind AS 111. It is only the assessment of a significant influence which is covered under Ind AS 28. So I think let me do one thing first of all to begin with. So I think let me first of all pen down an important thought. So we're looking at Ind AS 28. And in terms of Ind AS 28, we're looking at investments. We're looking at investments in terms of associate and in terms of joint venture. So one thing which I like to give it very clear so that the thoughts are absolutely clear indeed, that there are 2 kinds of investments which are covered under Ind AS 28. The first one is, we said, associate. The second one is what we call a joint venture. So as far as an associate is concerned, it is based on significant influence. It is based on significant influence. And a joint venture is based on the concept of joint control. And I think worth making a mention at this stage that significant influence, it is assessed. Here, the assessment is based on Ind AS 28. And a joint control, the assessment is based on, here, the assessment is based on Ind AS 111. So the assessment of a joint control is based on a different standard. The assessment of a sin influence is based on 28. But then let's also clarify one thing very clear, that once you look at this particular case, we can say the consolidation is as per Ind AS 28. The consolidation is as per Ind AS 28, and the method of consolidation is called equity method. The method of consolidation is called equity method, or you can call it as one-line consolidation. It is called equity method of consolidation, or it is called one-line consolidation. So that's a basic clarification as we go on to the standard. Now I'm going to first of all focus on the assessment of a significant influence in terms of block 1. So we're not going to spend too much time on the assessment of significant influence, but I think since we're given a couple of illustrations in the study material, we're going to make a conceptual walkthrough on the significant influence assessment. Okay, let's, I think, come back. Now, let's come to the concept of what is a significant influence in this case. It says an associate is an entity over which the investor has got a significant influence. Hence, to assess whether investee is an associate or not, we need to understand what is a significant influence. Now, see the definition contained in Index 28. Significant influence is the power to participate in the financial and the operating policy decisions of the investee, but it's neither a control nor a joint control. You can see one thing very clear, that when it defines the concept of significant influence, there is no percentage criteria. There is no rule-based criteria. It only says that there is a, you've got the power to participate. So the power to participate in the financial and operating policy decisions of the investee company is going to give you a significant influence. Now, we're going to look at the concept of how the significant influence is assessed. So there are a couple of parameters which are given in the standard. So I think I'll just quickly run the inputs to you. So I'll just maybe cut this across. We'll look at the illustration one later, but I think first I want to see the principle-based assessment. So I need to see the judgment, the principle required to make an assessment of significant influence. The standard has given us a couple of parameters in this case where we can see that when do we get a significant influence. Now let's read. The assessment of whether the investor has a significant influence over the investee requires an application of judgment. In making the judgment, we need to consider the following factors which generally demonstrate the existence of a significant influence. So the standard is telling me that when you look at the assessment of a significant influence, there are certain qualitative factors and not a quantitative assessment which will tell you that there is a significant influence. Number one, representation on the board of directors. As an investor, I have a representation on the board of directors of the investee. I'm not saying that you're going to get significant influence, but that can be, an indication that you may get a significant influence. Number one. Second, we'll look at the examples also later, but first let's make a run through of the inputs. Then there is a second parameter which is given in the standard. Then there is a second parameter, it says participation in the policy-making processes, including the participations in decisions about dividends and other distributions. The second parameter given in the standard is, as an investor, you can participate in the policy-making process. If you're able to participate in the dividend decisions, if you're able to participate in the other distributions, then we can say you can get a significant influence. Next. The next input which is given in the standard, is number 3, material transactions. Number 3, it says that there are material transactions between the entity, that is investor, and the investee. So if they've entered into transactions which are material in nature, that could also indicate the possibility of a significant influence. Next, it says interchange of managerial personnel. You've got common, you can say, directors in the company. The investor and the investee is supposed to be guided by common directors in the company. Interchange a managerial person could be another input as well. And then we are given a last clause as well. Then we are given another last clause as well, and that is provision. And that is what is called the provision for essential technical information. Now, as I said, we're not going to spend too much time on this subjective assessment, but the standard has given us one clear-cut thought. Let me now consolidate and connect all the dots. I did not read that part, but if you read Index 28, it very clearly says that there is a thumb rule which can be challenged. It says that as an investor, if you've got directly or indirectly 20% or more voting power in an investee company, it is implied that you get a significant influence and vice versa. So the basic thumb rule is that when you're looking at a significant influence as an investor, if I directly, indirectly, now that's another crucial point. The standard says that as an investor, you've got directly, indirectly. The word is directly, indirectly. You've got, let's say, 20% or more. Now, what is important in this case is when I say directly, indirectly, directly is understandable, but indirectly will always be through a subsidiary. I think, let me expand. Let me expand. This is another very crucial point in this particular case. Let me expand. So we're looking at the block number one. We're looking at the block number one, that is assessment of significant influence. That is assessment of significant influence. Now see what the standard says as a thumb rule. Now see what the standard says as a thumb rule. It says very clearly that as an investor, I'm taking two situations, A, B, A, B, C. Now watch the two situations very carefully. So I am considering no chain. I am considering a chain. Let's say A has got 20% or more voting power in terms of B. Let's say A has got 20% or more voting power in terms of B. This is what we can say directly held. This is what we can say that it is directly held. So B is definitely an associate of company A. A has got a significant influence by a thumb rule. A has got a significant influence by a thumb rule because he's got 20% directly voting power in terms of B. Unless there is anything to the contrary, we assume that with the 20% voting power, he gets a significant influence. Next. Now let's consider that A has got, let's say, a 60% stake in B, which means he's got a control. And B has got 10% stake in C, and A has got a 10% stake in C. Now, as investor A, he's got directly, indirectly. He's got directly, indirectly. So I can say this 10% is what you can say directly held. And this 10% is what we can say that it is indirectly held. Now, when you say that it is indirectly held, what is most important aspect is that it is indirectly held through subsidiary. It is through subsidiary. That is the most important input which is important. In this case, I would say A has got a 10% direct stake and A through a subsidiary has got a 10% indirect stake. So when you say as an investor that you've got indirectly, it should be always through a subsidiary. It should always be through a subsidiary only. So say, for example, if A has got a significant influence over B, then C will not be able to become an associate of A. because A should directly have, that is one, but when he has indirectly, his indirect holding should always be through a subsidiary, otherwise it will not qualify for the purpose of this standard. I hope I stand very clear on my thoughts. So in this case, we will say that A is got in terms of C 10% direct, 10% indirect. He's got 20%. So we can say that yes, C becomes an associate of this company. So this is the basic thumb rules which are given in the standard, that as an investor, if you've got 20% directly, indirectly in a company investee, you get a significant influence and the standard would trigger. And if you got generally less than 20%, significant influence will not trigger. But having made these rule-based assessment, you need to look at the principle-based assessment as well. So when you go look at the facts, you will say, okay, you got 20% or maybe less than 20%, it's fine. But let me also look into the parameters, and the parameters are, do you represent them on the board of directors? Are you participating in the policy making process, including the dividend distributions and other distributions as well? Is there an interchange, a managerial person? Is there supposed to be providing essential information, you can say essential technical support and all. So all these factors which we did, representation on the board of director, participation in the policy making process, and then interchange of managerial personnel, material transactions between the investor investee, and the provision of essential technical information. These factors will be evaluated along with the percentage held. So when you look at all these factors put together, then you reach a conclusion that, okay, maybe it's more than 20, but there is no significant influence. Maybe it is below 20, but there is a significant influence. That means I cannot make a significant influence assessment merely on the basis of the percentage. You may get more than 20, but there may be no significant influence. You may get less than 20, but because of all these factors put together, you may get a significant influence as well. So the thumb rule is one, but then these other factors which are judgmental also needs to be evaluated into account. I think let's pen down a few thoughts to begin with. So let me, I think, first of all, pen down a few thoughts at this stage. So let me just add something at this stage. So when we're looking in terms of assessment of significant influence, we can say there is a basic thumb rule. There is a basic thumb rule which is given in the standard. And the basic thumb rule is, if as an investor, you've got directly plus indirectly. You've got directly as well as indirectly. Indirectly means through subsidiary. So if you got directly, indirectly through subsidiary, 20% or more voting power, you can say significant influence is present. I would say significant influence is present in this case. Now, if you say, if as an investor, directly, indirectly, so directly, indirectly through subsidy, it is less than 20%. It is less than 20% voting power. We can say there is no significant influence. That is a thumb rule which is given in the standard. This thumb rule is given in the standard, that if you got 20 or more than 20, you get a significant influence, otherwise not. But we can say there is a principle-based assessment. There is a principle-based assessment as well. There is a principle-based assessment as well, and this will require judgment. And when we say the principle-based assessment, we can say there may be no significant influence even if percentage is 20% or more. even if the percentage is 20% or more. So there may be no significant influence, or we can say there may be significant influence. There may be significant influence even if percentage is less than 20%. So it does not make a difference. You may have less than 20%, but still you may get a significant influence. So that is what we call a principle-based assessment. And for this, we will look at factors. And for this, we'll start looking at the factors. So what kind of factors are we going to look at? Let's see the factors which we're going to look at. So we'll make a list of all those factors which needs to be evaluated to make a judgment. So let me just add the list of those factors as well. So we can say the factors which we are going to look at in terms of making the subjective assessment. So the standard has given us a total of 5 factors which we're going to look at the examples. So we can say the factor number 1 is that we can say that there is a representation. There is a representation of investor. There is a representation of investor on board of directors. So there is a representation of the investor on board of directors of investee. So I have a representation on the board of director. The second parameter is that you can say there is a participation. There is a participation in policy making. There is a participation in the policy making process. As an investor, I am able to participate in the policy making process, and this is including dividend decisions. This is including dividend decisions and other distributions. And other distributions as well. The third one is that we can say that there is an interchange of managerial personnel. There is an interchange of managerial personnel. So that could also be an indicative fact. There is an interchange of managerial personnel. Number 4. There is provision of essential. There is provision of essential technical information. There is provision of essential technical information. So we are providing technical essential information. And number 5. And the number 5 is in terms of, you can say, I think I forgot the point. So that was representation on the board, policy making, material transactions. The next one is material transactions between investor and investee. So there are material transactions between investors and investee. So there are material transactions between investor and investee. So these are the other factors which will be evaluated. So I hope you got the basic thought process clear. So as a thumb rule, when you look at the percentage, 20% direct indirect through a subsidiary, we say yes, there is a significant influence. If it is below 20, we say no, there is no significant influence, but you can get a significant influence even below 20. You may not get a significant influence even above 20. And for all this, these 5-factor list will be evaluated. As an investor, you represent them on the board of directors. You've got a participation in the policy making process. You're providing essential technical information. There is an interchange of managerial personnel. You've got material transactions between investor and investee. So this could indicate, that because of these factors, you could significantly influence the investee company. Right, friends? So far, so good. I hope my thought stands clear. Right? Now, I think we can start with the examples which are given in the study material. So let's, I think, have a look at the examples. One example each is given on all these parameters. We'll start with illustration 1 and then we'll go to the other examples as well. It says in illustration number 1, it says E holds 25%. So it says E holds 25% voting power of the investee, and the balance 75% is held by 3 other investors, each having 25%. A little clarification at this stage just to avoid confusion. Is it possible that in an investee company, one investor gets a control and another investor gets a significant influence? So is there a possibility that in the same investee company, one investor says, I control, other investor says that I've got a significant influence? And that's right, it is possible. So it says the decisions about financing and operating policies of the investee are taken by the investors holding majority of the voting power. Since the other 3 investors together hold majority voting power, they generally take decisions without the consent of E. Even if E proposes any changes to the financing and operating policies, the other 2 investors do not vote in favor of these changes. So in effect, the suggestions of E are not considered while taking decisions. So suggestions of E in effect is not taken. So if you look at the substance of the legal form, do you think E will get a significant influence? On papers, I've got a 25% stake, but the other 3 investors don't even allow, they don't even listen to me. I ask for changes, they don't accept them, and they do the meetings and take decisions without my presence. So do you think I am just having a significant influence on paper, or do you think in substance also I will get a significant influence? No. So determine whether E has got a significant influence. So it is not a rule-based assessment where I'll see the percentage and say, okay, there is a significant influence. I need to look at the substance of the legal form as well. And that's where the judgment applies. That's where the principle-based assessment would apply. It says since E is holding more than 20%, it indicates that E might have a significant influence. However, the other investors in the investee prevent him from participating in financing policy decision. Hence, in this case, he is not in a position to have a significant influence over the investee. So I think the facts of the case would be evaluated and a judgment would be applied. Next. Let's look at the illustration number 2. It says Cuckoo has got 12% voting shares in B, and B has got a board comprising 8 members, and 2 of these are appointed by Cuckoo. And it says each board is 1 vote at the meeting. Now we can see that he's got less than 20% voting power, but he's got a representation on the board of directors. We're not saying that this is 100%, a convincing evidence that yes, you get a significant influence, but I think we need to consider the facts of the case together. We cannot simply look at the 12% stake. We need to look at the combination that you've got representation on the board of directors along with the fact that you've got a 12%. So there is a possibility that you may get a significant influence. It says Boho is an associate of Cuckoo as significant influence is demonstrated by the presence of directors on the board and the relative voting rights at the meeting. Now, when you say the relative voting rights in the meeting, so we can say in this particular case, each board member has got 1 vote in the meeting. So there are a total of 8 directors. 2 directors are appointed by you. So when 2 out of 8 directors are appointed by you, 25% of the directors will agree with what you're going to say. So I think in this particular case, considering your relative voting rights, that you've got 25% voting rights, I think in this case, you get a significant influence. And more or less, let me also add another point as well. We can say that when you're looking at the concept of significant influence, the significant influence could come on account of either of voting rights, or it may come on account of right to appoint or remove the KMP as well. In this case, we can see that your percentage of voting rights is not the area which is going to help you to take decisions, participate in decisions. It says that every board member gets a right to vote at the meeting. So it is the board of directors which is making a decision. And I think if the board of directors is making a decision, I think the 12% takes a back seat. Because in this particular case, that 25% of the voting power is attained by way of directors in the board. So I think in this case, significant influence will come. Okay. Then there's something different which is given. That is the answer. Let's come to illustration 3. Now, in terms of illustration 3, we are given the inputs. It says M is got 10% voting power over the investee, and the balance 90% is held by 9 other investors which have got 10% each. The decisions about the relevant activities, it says except the decisions about borrowings of the investee are taken by the members holding majority voting power. The decisions about taking the borrowings are required to be taken by a unanimous consent of all the investors. Further, decisions about taking borrowings are not the decisions that mostly significantly affect the returns of the investee. Whether M gets a significant influence over the investee or not. Now we can see in this particular case that even though his percentage stake is merely 10%, but we cannot conclude that he's got no significant influence. We need to look at the facts of the case as well. So although he's got less than 20% voting power, his consent is required to take decisions about taking borrowings, which is one of the most relevant activity. In fact, we made a mention of this earlier as well when we were looking at the concept of control. Even in terms of the control assessment, as an investor, you are able to take decisions on the relevant activities of the investee. And here again, that as an investor, you are in a position to take significantly influence. You're able to participate in the decision making, which are the relevant activities of the investee. You get a significant influence. Further, since the decisions about taking borrowings are not the decision that mostly significantly affect the returns, it cannot be said that all the investors have a joint control over the investee. So I think considering that a unanimous consent of all the investors is required, I think that proves that the participation rights are important for all, and therefore significant influence could be achieved. Let's look at another one, illustration 4. It says RS is an entity engaged in business of pharmaceutical. It is invested in the share capital of investee and he's got a 15% voting power. XY is engaged in the business of producing packing material for the pharmaceutical entity. One of the incentives for RS is to invest in XY is the fact that XY is engaged in the business of producing packing material, which is also useful for RS. Since last many years, XY is almost 90% output is procured by RS. Since they are dealing with each other, 90% of the transactions are being dealt with each other. That's quite material in nature. 90% of the transactions would indicate the materiality level, and since the materiality level of the transactions indicates the dependency level, he can definitely have a significant influence as well. Since 90% output of XY is procured by RS, XY would be dependent on RS for continuation of the business. Hence, even though he's got only 15%, but I think significant influence will come. This is more like indicating a financial dependence as well, where you can easily influence the other person that if you don't listen to me, see what can happen to you. So, I would say this seems to be, much more than a significant influence to me. But of course, you can't establish a control with 15% stake. Otherwise, I think it's definitely quite a strong influence on the investing. Next. It says entity X and entity Y operate in the same industry, but in different geographical regions. Entity X acquires a 10% stake in Y as a part of the strategic agreement. A new production process is key to serve a fundamental change in the strategic direction of Y. The terms of the agreement provide that Y will start a new production process under the supervision of two managers from entity X. The managers seconded from entity X, one of whom is on the X board, will oversee the selection and recruitment of the new staff, the purchase of the new equipment, the training of the workforce, and the negotiations of the new purchase contract. And the two managers will report directly to Y's board as well as to the entity X. I think those key management people who are the decision makers of the company are supposed to be appointed by the investor. So in this particular case, since you can say there is a common managerial person in this case, definitely significant influence will come. So are all the five factors to be considered for substance of a legal form? No, any one of the factors could be present. It's not that all the five factors will be present in entirety. So you need to see that you've got less than 20, where the combination of any one of the factors could indicate a significant influence. Not all five, just any one, or maybe a combo of more than one.
Sir, if we have got 20% or more, but there is no contraindication, then we can safely assume that it is a significant influence.
Yes, yes. Because the standard also very clearly says that there is a general presumption that if you got more than 20, unless there is anything to the contrary, you get a significant influence. Correct. Sorry.
Thank you. Thank you.
Yeah, you're welcome. Okay, then it says the secondment of the board member and the senior manager gives entity a range of power over the new production process. And this assessment could indicate that yes, he could influence the company. Next. It says R is a tire manufacturing entity and the entities entered into a technology transfer agreement with another entity Y, which is also involved in the business of tire manufacturing. R is an established entity in the business, whereas Y is relatively a new entity. As per the agreement, R has granted Y a license to use the technical information and know-how which are related to the process of manufacturing tires. Y is dependent upon the technical information and the know-how because of the lack of expertise and experience. The investment is merely 10%. I think again the dependency factor in terms of the technical know-how, I think makes it a clear-cut case that significant influence can be present. So in all these examples, you can see the substance is prevailing over the legal form of the transaction. So we can say he obtains essential technical information and therefore he should get a significant influence as well. Wow. So I think that takes care of our assessment of a significant influence. Just a concluding sentence before we go further. So we can say, unlike you can say Index 110, where there is no direct reference in terms of that control is a rule-based assessment, but I would say in terms of Index 28, some way or the other, they have made a mention that it is, per se a thumb rule assessment. So as we said, that as an investor, you get 20% or more voting power directly, indirectly through a subsidiary. You can presume that there is a significant influence unless the facts will prove it otherwise. If you've got less than 20%, we can say generally you cannot get a significant influence unless the facts can be proven otherwise. Now, what are the other facts to be seen are the list of these five factors. So once you look at the cases, you look at the facts of the case, you apply the judgment, and then accordingly you lead to a conclusion that yes, there is more than 20% voting power, but still no significant influence. Illustration 1. There is less than 20% voting power, but still there is a significant influence. The illustration number 2 to illustration 6. Now comes another important clarification. When we did the concept of control assessment, we also said that a potential voting rights could be indicative that you get a control or not. So let us see what is the status of these potential voting rights in terms of Index 28. There is an interesting clarification which is given in illustration number 7. Now I'll just read the facts and then we'll connect the dots in terms of 28 as well as 110. We're talking of the potential voting rights, whether they will influence the significant influence assessment or not. It says an entity which is currently holding 10% voting power has the option to purchase additional 15% voting power of the investee. So that would make it 10 plus 15, 25. However, the entity currently does not have the financial ability to purchase these 15% voting power. Determine whether significant influence is there or not. So you've got the option to purchase, but he says financially you are not in a position to purchase. You do not have the funds which is required. Now let's see the assessment which is given out here. Considering the potential voting rights, the entity can have more than 20% voting power, and hence it is presumed that you get a significant influence over the investee. The fact that the entity does not have the financial ability to purchase additional voting power is not considered in such assessment. It should be noted that under Ind AS 110, potential voting rights which entity cannot exercise because of the financial ability are not considered as substantive and hence not factored in the assessment. However, in this 28, there is no such requirement given. Hence, the potential voting rights, even if they are not substantive, as per Ind AS 110, are included in the assessment of the significant influence. Now, watch this carefully again. It says the fact that entity does not have the financial ability is not considered. So there is a difference in terms of Ind AS 28 and in terms of Ind AS 110 as far as the concept of potential voting rights is concerned. So I think to put it in very simple words, if you're looking at Ind AS 28, your inability, your financial inability, that whether you will be able to exercise those options or not is not factored into account. I would say you've got the option, great, you've got significant influence. But in terms of Ind AS 110, we do factor that into account. So we do consider that if you've got a financial inability to exercise, then in those particular cases, you will not get a control. That's a wonderful comparison. So let's, I think, put a very important note at this stage. So here becomes a clarification note with reference to the two comparative standards. We're looking at the concept of potential voting rights. We're looking at the potential voting rights. So in case when there is no investment, but there are material transactions, can there be a significant influence? Well, to my mind, it is very subjective. And if you ask me technically from a practical point of view, I would say no. I would say no. Because, practically what happens that if you've got, a percentage which is much, much below 20%. Now, if you're talking of, I've got a 5%, 8% voting power, and you're getting, other these factors are there, it's a difficult assessment. It's difficult to prove. Because I think if you're nearing 20, if you're nearing that 20%, I can't define any given percentage that whether nearing 20 is 15 or 16 or whatever. But I think if you're quite close to 20% and with these additional facts, you can get a significant influence. But if you're too far away from the 20%, I think it's a difficult assessment to do. So though it is subjective, though it is judgmental, but I think practically it will be difficult to prove that kind of significant influence in that case. And then, it's also, I read, in some of the publications, not on significant influence, but on account of control assessment, that if you got, let's say, around a 25-30% voting power in a company, and you've got other factors quite indicating that you've got a control, it's a difficult case of consolidation. Because if you say that at 25%, I'm going to do a full consolidation, and I'm going to show a 75% NCI, it looks a very, aesthetically a very wrong kind of consolidation. I think drawing the references from there with a no investment in hand, how would you do the equity method consolidation? That's also the biggest problem. So I think there will be other challenges of consolidating as well. So my personal viewpoint on that would be no. Correct. Okay, so coming to the points, as we said, we're looking at the concept of Index 28 and we're looking at the concept of Index 110. So we can say that we've got an option to buy, we've got the option to exercise, and we're looking at that there is ability, the financial ability is there. We're looking at the permutation, financial ability is there, or the financial ability is not there. So I think let's make it clear in the form of the chart out here. So when you say in this particular case, in terms of Index 28, financial ability is there or not, we can say significant influence is there. It does not make a difference to me whether financial ability is there or not. You have got exercisable rights. That's enough for my assessment. But when it comes to Index, here we can say control is there. Here we will say the control is there, but here we will say control is not there. If you say that there is no financial ability, the control in this particular case is not going to be there. So that's a distinction in terms of how the potential voting rights under the two different standards are interpreted. Okay, so far so good. So that takes care of my block number 1, that is the assessment of a significant influence through which you will decide whether we are under the purview of this particular standard or not. Okay, now let's go further. Now I am going to take you to the block number 2, though we'll do our extensive discussions, of course, practicals in the next class. But at least let's give you a conceptual framework to decide. So we're looking at the block number 2. We're looking at the block number 2, which is on equity method of consolidation. Which is on the equity method of consolidation, what we can say is called a one-line consolidation technique. It is called a one-line consolidation technique. Trust me, the consolidation method as per equity method is fairly simple because we are going to apply this in a simple two-step model. I gave you a little flavor of this earlier as well, but let me, I think, give you now concrete inputs on this. So I would divide my entire application of equity method of consolidation in terms of two-step model. Step 1 and step 2. The step 1 is on the date of acquisition, and the step 2 is in terms of post-acquisition changes. So we'll divide our accounting of equity method in 2 stages. One is the date of acquisition, and one is, you can say, in terms of post-acquisition changes. Let's take a simple example to illustrate this point. Let's consider that a company A acquired in terms of company B 25% shares, and this was acquired, let's say, at 30 lakhs. And let's say the total net assets of B is to the extent of 100 lakhs. Would you like to tell me what is the goodwill at this stage? This is the cost of the investment, and this is the net assets of B on the date of acquisition. As an investor, I get a 25% stake in the company. So can I say I get a 25 lakhs of net assets? So would you like to tell me how much is going to be the premium or the goodwill which is paid? 17.5? No. I guess I paid 30 lakhs. And out of that 100 lakhs, you get a 25% share, right? So can I say you can compare 30 versus 25? So can I say we get a goodwill to the extent of 5 lakhs? So the step number 1 is to identify the goodwill or the capital reserve which is paid on acquisition. That's it. Now, let's assume if I were to make a consolidated balance sheet on same date itself. Let's say if I were to make a consolidated balance sheet on the date of acquisition itself, this investment will appear in the consolidated balance sheet at 30 lakhs itself. In the separate and in the consolidated financials, it'll appear at 30 lakhs itself. In the brackets, you will disclose. In the brackets, you will disclose that there is a goodwill to the extent of 5 lakhs. The goodwill does not appear as a separate line item. The goodwill is going to be appearing as a part of the carrying amount of the investment. This 5 lakh rupees will be appearing as a part of the carrying value of the investment. That's it. Now, this is one thing. Now let's make your life simple. So this is the treatment on the acquisition date. The investment will appear in the balance sheet and the goodwill is going to be disclosed as a part of the inner column. Now, once you look at the post-acquisition changes, the accounting is simple. Let's say this is the net assets of the investee, associate. And let's say this is the investment. What do you need to do now? Track the net assets, track the post-acquisition movements of the net assets. If the net assets of the associate goes up, I will increase the investment. And that is to the extent of share in the increase. If the net asset goes down, I will decrease the investment to the extent of share in the decrease. So in the step number 2, what I will do, I will track the post-acquisition changes. If the net assets of the associate goes up, investment will be debited, increased. If the net asset goes down, the investments will be credited, decreased. So what we're going to do, we will track changes in. We will track the changes in net asset of the associate company. We will track the changes in the net assets of the associate company. So if the net asset goes up, increases, we will also debit the investment, increase it, but to the extent of share in increase. To the extent of share in that increase. And if the net asset decreases, then I will do a credit to the investment, which is again to the extent of share in the decrease. So you need to basically capture the changes in the net assets of the company. Net asset goes up, investment debit. Net asset goes down, investment credit. So every change in the net assets will debit or credit the investment to the extent of share. But I need to pass a complete entry. So what is going to be the corresponding credit or what is going to be the corresponding debit? Simple. Mirror accounting. Mirror accounting is what we're going to do. If the net assets of the associate goes up, the credit went to P&L. The investment, I will also as an investor credit P&L. If he credits OCI, I'll also credit OCI. So you can say the second aspect. You can say the second aspect that is the corresponding. That is if I'm asked for the corresponding credit or debit, we are going to use what I call mirror accounting. So for the corresponding credits or debits, I'm going to use what is called a mirror accounting. So in terms of the mirror accounting, we will do the same credit, P&L, OCI, equity, as the case may be. If the investee credits P&L, I credit P&L, credits OCI, credit OCI, equity directly credited, equity directly credited. How does this exactly happen? Of course, we'll see in the practical illustration. But right now, I just wanted to give you 2 thoughts on the equity method of application that when you are looking at the step 1, just compare the purchase consideration versus the share in the net assets. Get the goodwill. That goodwill is not going to be a separate line item, but is going to be a part of the carrying amount of the investment. Then in terms of step number 2, you'll keep the track of the net assets. The associate net asset goes up, investment debit. Net asset goes down, investment credit. And the corresponding credits or debits, same as the associate. He credits P&L, I credit P&L. He debits I debit OCI. A mirror accounting will follow. That is how only the investment will appear in the consolidated balance sheet. As per the equity method of consolidation, the only figure which will appear in the balance sheet is investment. No aggregation of assets and liability. Unlike Ind AS 110, just the investment appears as a single line item. So in the next session, what we're going to do, we're going to work upon examples on equity method of consolidation. And then we'll look at the same 5 adjustments which we talked of in terms of 110, how those adjustments will be taken care in terms of associate. And then maybe, we can join a question where there is a subsidiary and an associate consolidated balance sheet, subsidiary and an associate consolidated income statement. I think that will give us a complete overview of all the inputs together. Then there is another third block, which I said, which is on the concept of other long-term interest in terms of associate company. That would be in the block 3. So all this coming in the next session with you on the associate accounting. I think that seems to be all for the day. So we're going to carry forward this journey in the next class, friends, with you. Unless you've got any questions so far. Otherwise, I think we are done for the day.
So net asset of B is fair value or carrying value?
For the purpose of step number 1,
Yes, sir.
fair value. We're going to compare the purchase consideration versus net assets on acquisition date at a fair value. Same exercise what we do in 110, so fair value.
And sir, I have also doubt in CFS.
Mhm.
Sir, asset which is not appearing subsidiary balance sheet, which
Hmm.
is brand value.
Yesterday it came in the exams, right?
Yes, sir. So
That
what
will be a
is
part of the fair value adjustments.
fair value adjustment?
So, like for any intangible asset which is not in the books of the subsidiary, but the fair value of that intangible assets can be assessed. So in terms of consolidation, when you do the step number 2A analysis, you should take that fair value increase because there is no book value in the pre-acquisition column, and any amortization should be taken in the post-acquisition column. So treat it as a fair value adjustment.
Okay, sir. Thank you.
You're welcome. That's what, new point came in on consolidation yesterday. So many people might have thought, how to do that, but I was very, happy to see that, that's a good point indeed.
Yes, sir.
Right, friends. So I think that's it for the day. So time to say goodbye to you. So see you in the next class. Thank you. Bye-bye and take care. Haji, thank you. Same to you.